Hey everybody, and welcome to the Sustainability in Motion podcast, brought to you by ED4S. We focus on the fast-moving sustainability world to help the business community better understand the sustainability and environmental challenges we face. My name is Matt Orsagh, Chief Content Officer at ED4S.
Hi everyone, this is Maria Maisuradze, founder and CEO at ED4S.
We have as our guest today Jo Paisley, President of the GARP Risk Institute, where she leads research for GARP on the larger risk community. Her distinguished career includes stints at the Bank of England and HSBC as the Global Head of Stress Testing. Jo, welcome to the podcast.
Thank you very much for inviting me.
Good to have you.
Well, Jo, thanks for accepting to be on the podcast. We are big fans of the GARP's Climate Risk podcast, so it is really cool to have your insights and be guest at ED4S. So one thing that always fascinates me about the economists or finance professionals emerging in sustainability is the journey, how they got here. And so could you please walk us through that journey? I know you started at Bank of England and you had multiple roles there as economist and leading the statistics divisions and later in supervision. So could you tell me what was your aha moment and how did you actually end up working on climate risk and sustainability?
Yeah, no, it's interesting actually, because I think I'm a bit of a late comer to this whole issue, because I was at the Bank of England for 23 years as an economist, headed up. I know now you're looking at me as if to say, God, you really are old.
No, distinguished career is what I was
Distinguished, that's nice, yes. I first joined as a graduate as an economist, then ran statistics, then ended up in supervision and risk. And in all those 23 years, climate change wasn't actually mentioned once, funnily enough. And it only really got going when I left. Don't think it was cause and effect, but Mark Carney did a speech, the Tragedy of the Horizon speech in 2015, and that was after I'd left for HSBC. So it was interesting. It wasn't through being at the bank, nor through being at HSBC that I got interested in this. Ironically, as I was thinking about this, I thought you might ask me, and I think the first moment when I thought, God, this is something that I really want to think about, was watching An Inconvenient Truth. And ironically, I was on a plane at the time. And I remember thinking, because even when Mark did his speech, I was thinking, God, but climate change is, it's a long way out. Why is he so worried about it? And I sort of squared it thinking, well, maybe it's because it's insurance companies with long dated assets and liabilities, so I can still not worry about it. But I watched the film and then I thought, well, that's interesting. Why have I never thought about this as an economist? So then I started reading a little bit more. I read Donut Economics. I don't know if you've read it, by Kate Raworth, which I thought was really, really a great book. So I thought, well, that shows that economists generally haven't thought about it. And I joined GARP in January 2018, and I was sort of given a blank canvas on what to look at. And the first 6 months or so, we were doing a whole range of things like stress testing, operational resilience, but I continued to read quite a lot. And I read a book by Mark Linus, which is called Our Final Warning, which was horrifying, actually, because it sort of told you what was going to happen at each degree of warming. And I was trying to work out how to incorporate it in our work at GARP. And I think what really clinched it was I was on a weekend away, actually, with some friends who'd joined the bank with me all those years ago. And one of them was Sarah Breeden, who's now Deputy Governor, but she happened to be in charge of the climate change work at the Bank of England. And on the way back from France and the Eurostar, I started talking to her about it and said, I think there are real risks from climate change, but I don't think people in the financial community are really thinking about it, not widespread. And I think maybe we ought to do some work on trying to mainstream it within day-to-day risk management. And I just asked her what she thought. And then she started telling me about all the work that was going on in the regulatory community. So, for example, the formation of the NGFS, or Network on Greening the Financial System. That was kind of the international agenda, if you like. And then domestically, the PRA were coming out with their own supervisory expectations SS319. And ironically, today, they've just published revised expectations as well. So it was clear there was an awful lot going on. And I found this really stimulating. I went and talked to my boss and I said, I think this is the area that I really want to focus on. So a bit of a long-winded answer there, but a combination of my own personal interest, but also, a recognition that this wasn't being treated really as a risk, which is what I thought it ought to be doing.
And that was about, 10 years ago?
That was 2018, yes, so 7 years ago.
2018, yeah. Okay. 7 years ago. Yeah. Okay. Well, for those who don't know GARP, we're GARP fans here. We think GARP does great work. They have a great podcast, as we mentioned. They have some great educational tools that I've used that I would like, shameless promotion for GARP. We think you guys do good work and people should know about it. But for those who don't know, which is probably a lot of people, what is GARP? What is the purpose of GARP? And then, the little section of GARP you guys work in with your team. What is the GARP Risk Institute and what do they do?
Yeah. So GARP is the Global Association of Risk Professionals, and we're a US-based not-for-profit that focuses on risk education. And our mission is to raise the standards of risk management globally through education, research, and the promotion of best practices. So we do a number of different things. Our main business is education, setting exams. So we have the Financial Risk Manager certification. It's like a master's level qualification.
Right. Yeah, I'm familiar. Yeah.
And then just about 6 years ago or so, we introduced the Sustainability and Climate Risk Certificate. It's a bit less onerous, a bit less quantification in there, but really covers the foundations of sustainability and climate risk. And then just recently, we've introduced the Risk and AI certificate as well. So we've got other products as well, but there are three main ones. And then we do a number of different things around the world. So, for example, we've got chapter meetings where we have local risk practitioners get together with others and we help support that. So it must have about 30 around the world. And that helps the promotion of best practices and helps create this community of risk professionals. We do events, we have membership. The Risk Institute was set up when I joined, and that is, we can work on any aspects of risk we want, but we decided we wanted to really focus, because if you spread your focus too widely, you don't actually have any impact. And so we have chosen to focus on climate, nature, sustainability risks. And the reason for focusing on that really is just because they are so all-encompassing and they're not embedded within risk management yet. And the more I read about it, I continue to read a lot, the more I realize that it is very complicated. And, we're just doing our best to try and get as many people aware of those risks and doing something about it in their day-to-day jobs. In terms of what we do, well, a bit like you, we try and work out how we might get the message through to people in a variety of different ways. We started the podcast, it must have been about 5 years ago now, because I know that, quite a lot of people like listening to podcasts. And this is the first podcast I've ever been on, actually. So it's quite interesting to be on the other side. Yeah. We do webcasts because some people like, for some content, I think a webcast is better, where it's live and you've got slides, if it's complicated material. We do articles. We do benchmarking as well. We benchmark firms. So this is quite interesting, and we might talk about that, but that's where we actually work out how good firms are at certain things, and then we can provide them with feedback, and that helps them know where they are in a distribution, and it also helps us understand what is the level of maturity across the industry. And, events, roundtables, conferences, all the usual things.
This episode is brought to you by ED4S, the sustainability training solution designed for scalable workforce training. ED4S makes it easy to build, launch, and maintain time-efficient, role-specific sustainability training for your teams. Developed by industry experts and trusted by leading organizations worldwide, visit ed4s.org to download a free case study and see how ED4S can work for you.
As we kind of onboard finance professionals and engineering and business professionals to sustainability, which come from all types of broad areas, whether it's marketing, investment management, client services, as they enter into this world, often enough, they want to learn more. So the certificate that you have, the Sustainability and Climate Risk, is actually one of those programs that we recommend as a natural next step, especially if they're interested in the risk side of things. So Sustainable Investing certificate by CFA is another one. But we feel that it's a very natural and great continuation. Once you have this awareness and understanding, you want to go deeper. The course that you have created has certainly gotten very positive feedback and is a great way to continue on the journey. So that leads me to actually talk about the complexities that you mentioned earlier. And you do produce a lot of content and a lot of research, which is, as you said, freely available. And I invite everyone to visit garp.org to discover all of that great stuff. Climate change is something that's been on agenda for a while. So, starting from Mark Carney's speech, and it's much easier to quantify. It's a topic that's maturing quite nicely, but nature is something that's emerging and it's much more complex, harder to quantify, understand. So I know you've been doing some work around nature and that you're about to publish on May 6, 2025, the Nature Risk Management Survey outcomes. And would love to learn what the key takeaways are. What are you finding from different institutions? How are they progressing on being able to measure, assess, and prepare when it comes to risk management and nature-related risks?
No, thanks. So this will be our second nature survey. We did 4 climate ones starting in 2019, ending in 2022. And we sort of saw over those years a steady progression in improvement, particularly growing sophistication, if you like. So the quantitative side of risks management, measurement coming through towards the end. And last year we decided we really needed to look at nature risk management because for a number of reasons. Firstly, because us, like many people, we realize that you cannot combat climate change without a resilient nature.
Yeah.
But also we see more regulators looking at nature risk management. You've got the things like the TNFD, the Task Force on Nature-Related Financial Disclosures, a lot more interest in nature. And so it seemed appropriate for us to start benchmarking firms on their nature risk management. And so the types of firms that we look at are banks, asset managers, insurers primarily. And we sort of follow a similar structure as we did for the climate. So we look at their governance, their strategy, their risk management, their use of metrics, targets and limits, their use of scenario analysis, and their disclosures. Now you might say, why disclosures? Because that's an odd category, isn't it? But we actually use it almost as a cross-check because we tend to find that the firms that do well on disclosures are actually doing better on the other categories as well. And so these 6 categories, we've got a bunch of questions and we score the ones that are most related to their capability at risk management. And then they score out of 100 for each block, so a maximum of 600. So the sorts of things we found in this second survey is, overall, I think we describe it as an emerging discipline, which is to say that we're still in very early days. We're still 6-7 years behind climate, maybe. But it's all edging up. So when we look at, board oversight, for example, like one of the foundational things, half the firms in the 2025 survey have board oversight. It's just marginally higher than the number in 2024. But it's interesting, 17% of the boards have that responsibility, but they still haven't actually been presented with any papers. So I would be concerned if I was on a board of a company and I had that responsibility and I had no information about it.
Yeah,
so I think there's
debt liability.
Exactly. There's some real work to be done there. We've got 42% of the firms have actually identified nature-related risks or opportunities, and that's up from 25% the year before. So what you tend to find when it really gets going is when they start spotting commercial opportunities. It's not just about the risk management and measurement, which doesn't get quite the excitement in the firms, or might do in our audience, but that's when they think they can make money out of it, then things really start to get going. But interesting things like counterparty risk assessment, that's actually increased quite a lot. So this is where, say, a bank will be assessing the nature risks that one of their counterparties has. So maybe it might be water availability, or it could be their use of raw materials, or maybe risks in their supply chain. So that's come up quite a lot. You got about over 40% doing that, and that's up from under 30% last year. Not much use really yet of metrics, targets and limits. It's still early days, and I'm not really surprised at that. We saw with climate that it took many years for the measurement to develop mainstream. But you do find that quite a lot of the firms are working on it. So I think over 60% of them say they're actually working on it. So there's quite a lot of homework being done at the moment, and very limited use of scenario analysis. And I'm not surprised at that either, because the regulators haven't really got going on nature scenario analysis. And that's when it really took off with the climate work, is when the regulators ask you to be in a climate scenario analysis exercise. That's when the resources really get committed. But I think it's a matter of time. So I think it's kind of early days, but I can see that firms are beginning to get going on it, and it's quite encouraging, and especially when you factor in what they intend to do.
That's really interesting. Could you tell us a little bit more about specific risks that these financial institutions are maybe talking about top of agenda? You mentioned water. And the counterparty risk, are there any other ones that you could share with us?
Yes. Well, when you're looking at kind of what's driving nature loss, tend to think about impacts and dependencies. So if you are a bank lending to, a diversified portfolio, you'll have in that portfolio, you'll have manufacturers, you'll have pharmaceutical companies, chemical companies, or whatever, and they'll all have distinct nature-related risks and opportunities. So I tend to focus more on the risks, obviously. So it could be water availability, but it might be that they depend upon, maybe they're an agricultural firm and they depend upon pollinators to pollinate their crops, and it might be that there's a problem with pollinators. Or it could be that they are having an impact on nature through pollution. Say they're, a textile manufacturer or whatever, and they're using dyes, and there's pollution into the local waterways. And then they'd be subject to possible litigation or to regulations, and that would be a different type of risk for a firm that was lending to that company. So there's a range of different ways that nature can give rise to risks. It could then manifest through credit risk, or it could be, market risk. But at the moment, people really are thinking about, can they locate these risks and can they kind of assess them? And it's almost as much qualitative, I think, as quantitative at the moment. And I think a lot of these risks have been around, obviously, for forever. But this focus on the ability to label the risks in a common way and to be able to aggregate them up across the firm, I think that is new. It's more systematic, if you like.
Yeah, I could see the challenge, but financial institutions don't really have the access to the first-hand data. So I could see maybe we'll start as proxies the way we did with the carbon data. And hopefully with a bit of pressure and maybe regulation, the companies will start increasingly measuring, assessing, and disclosing this. I know ISSB is doing some work around understanding the financially material risks from nature topics. So it would be great to see this evolution to accelerate a little bit big, because it is certainly so complex. And for financial institutions to just do it by themselves, it would be just meaningless.
Yeah, I think that's right. But when we started on climate back in 2019, I remember thinking, I don't know how they're going to do this. This is really hard. And then you look now at the sophistication of some of the providers out there, the data, the quality of the analysis, and it's a real ecosystem that has built up. And it's happening in the nature side as well. There are a lot of data sources out there. One of the challenges for an institution, though, is how do you get that data into your own systems? You know, how do you tag it? How do you make sure that, you know, with this transaction, you've got the appropriate information? And so it's with any risk, any new risk, there's this sort of, you know, a build up of an ecosystem and build up of expertise. And we're just in the early days, I think, at the moment.
That leads nicely into our next question that we wanted to ask is, what do companies and financial professionals still get wrong about sustainability risk? And if wrong is too strong of a word, what don't they understand? You know, what are the best ways at closing those gaps? And you just talked about that a little bit. These are such early days. What are the best ways to close those gaps quickly? And what do people still have misconceptions about, I guess, around this data?
Yeah. I mean, I think one of the biggest problems at the moment is viewing it as a compliance exercise rather than really thinking about it as a risk. I think particularly it might be because the reporting frameworks are almost leading it. So TNFD has done a great job. But then it gets into the wrong part of the institution. It's the reporting part rather than necessarily the risk part. I think that is a problem. Either that or they view it as a sort of corporate responsibility, corporate social responsibility, in which case then it's about, you know, I don't know, investing in a local wood or something like that, you know, rather than really thinking about those risks that are affecting their counterparties. So I think that's probably the biggest thing. And some people just don't even think climate change is a risk. I think it's extraordinary. And I think part of it is the way that climate change is framed. So when we talk about 1.5 degree warming or even 2 degrees, you know, a lot of people don't think that sounds that bad. Of course, it's not. That's an average. And we're talking about the whole distribution. And what we're really worried about is the tail risks. So we've seen tail risks manifest already. We've seen more and more extreme events. And even though they might be manageable in themselves, it's when you start getting them, you know, time and time again, communities being wiped out by flooding or wildfires or whatever. And the amount of money that's going to have to be spent to rebuild those communities, as well as, of course, you know, just the impacts on human beings, on nature, it becomes a real problem. And then you factor in some of the things that we're really worried about, like cascading risks, you know, risks that feed out into other things. So they lead on to civil unrest, droughts, war, massive migration. You can paint some very dark scenarios quite easily, actually. And I've always thought that one of the problems with risk management is in good times, you sort of forget about how bad it can be. And we sort of lose our ability to think about some of these tail risks. And so I suppose in terms of the errors that people are making, I don't think they are thinking about these tail risks sufficiently. And that's on the physical side, probably more so. But when you think about the transition and the scale of what needs to happen, we're talking about another industrial revolution, really, which presents us with enormous opportunities to make the world safer and better and greener and healthier. But it's not going to be an easy journey. So it's not, I mean, we can see it now. There's a lot of resistance. And so in those kind of volatile times, there's a lot of scope to make or lose a lot of money. And that's where risk people, you know, we're not talking about eliminating risk. We're talking about understanding the risks and managing those risks. And you asked Matt about the best way to close these kind of gaps. I'm not really sure, to be honest, because sometimes you can tell people all the facts and figures that you've got and they still won't listen. So I think when we talk about people's journeys right at the beginning, people do come to this from a range of different perspectives. Sometimes it can be as simple as just seeing a film, like it was with me, it sparked an interest. Or they go on holiday and they find that where they thought there was a glacier, there isn't one anymore. Or there's such severe plastic pollution, they just can't believe what's going on. It could be a very personal experience like that. Or it could be that they lose a lot of money in extreme flooding or whatever. But apart from that, I find it quite difficult to know exactly how to communicate this, because I think people listen in a range of different ways. That's why we do the podcasts, the webcasts and everything. And, I'm sure that you do the same as us, but we get a range of different guests on the podcast. So we come at this from just a host of different angles in the hope that some of those light bulbs will come on when they hear something that really resonates with them.
It's a changing of culture, and that happens very slowly, whether it's, the culture of GARP and the risk professionals, culture of investment professionals, culture of society. We've been blessed to live in a very Goldilocks zone climate-wise in human history. And messing with that a little bit, we could start seeing the cascading things that are happening. But the culture hasn't caught up with that yet. And hopefully it will more quickly.
How come this facts and science is yet not reflected in any financial models? And obviously, people that are doing the work today has been trained in a certain way. They've got their brains configured in a certain way. And economics, which is really not a real science, no offense, Jo, but he has kind of given us this framework that we take for, the rule of world. And we're still operating in that. Frankly, I don't think the current economics, the way they're being taught at universities, should be taught that way. And I think book like Donut Economic and Kate Raworth's work should be really part of that curriculum. So we can start rewiring people towards a more holistic view of our world, right? The economy doesn't operate in a silo. It is dependent on stable society and environment. So that leads me to our final question, because we are already towards the end of our episode. When it comes to sustainability-related risks, we talked about the fact that although we have all the facts and figures and scenarios, it doesn't seem to translate into change in modeling or behavior or decision-making. Based on your analysis, what do you think maybe are the closest risks they're actually currently translating? And I'm thinking about insurance industry. That's probably where the dollar impacts are already being felt. What do you feel are the closest risks that the financial sector currently need to address, upskill, and prepare for in the context of, global challenges? And I'm opening this question to all kinds of potential risks that you could bring up. Maybe it's misinformation, maybe it's social unrest. We talked a lot about the environmental risks today, but obviously the risk industry is not just focused on that. So maybe it's AI. So I'd love to hear what you think about the very current risks that financial institutions would need to address and they're not addressing enough.
Yeah, it's a good question. And I don't know in terms of the risks to society of any greater risks really than climate change and nature degradation. That's partly why I focus on it. I mean, I did read a book called The Precipice, and this was all about existential risk for humanity. And funnily enough, this is Tony Orb, who's an Oxford philosopher. He was looking at what are the risks that could wipe out society. It's a bit of light reading, And he put the chances of climate change and biodiversity loss wiping out humanity at about 1 in 1,000. But actually the risks of generative AI at more like 1 in 6, something like that, which did make me think, maybe I should look at AI instead. And by wiping out humanity didn't mean just like literally all of us die. It meant that maybe locking us into some sort of dystopian future. So I do think the risks from AI are fascinating and extremely challenging. And I don't know if you've read the book by Nexus, which also looks at this. So I've been reading much more about AI because I'm genuinely very, very interested in it. And there are some real challenges for society here where, you know, we could imagine a future where we literally can't tell if what we're seeing is real. And I can't imagine a future like that. So that worries me deeply. I'm assuming that others are thinking about that because I'm still focused more on the climate and nature side, because I think without that being dealt with, you know, we will have no sort of decent livelihoods anyway. So I think there's a whole load of risks out there which are really quite terrifying. Perhaps everybody thinks this at some point, that the future is scary, but we do seem to have unlocked the potential for our own undoing with AI if we're not going to handle it properly and regulate it appropriately.
Yeah, I could totally relate, and something I think a lot about as well. And we're talking about short-term and long-term risks, and you could see how they're all interconnected, right? The spread of misinformation and polarization in today's society being amplified by AI algorithms in the back. So, you know, we can talk about science and climate a lot, but it still is so marginal because we can't agree what's truth, and that comes down to really a human aspect and really hard to manage because it's not finance and data anymore. It's really deeply psychological and human. So interesting times.
Well, you know, how are we ever going to get consensus for tackling the climate crisis or dealing with nature degradation if we can't agree on the facts, if we can't agree what's true? It seems like such a fundamental thing. And I feel that we're playing a bit fast and loose with it, actually. Should we end on a high note? Should we get back to something a bit nicer?
I was going to propose that.
Well, that is a profound way to end.
I vote for that.
I think it's a very thought-provoking way to look at things, and that's not bad. You know, I think we need to be aware of the time we're in, and I don't think that's a bad way to end things.
Yeah, we don't want to sleepwalk into a dreadful future. The thing with AI is it's phenomenal in its potential to help us.
Right.
You just think about, you know, if you use ChatGPT or whatever, you type something in there, it really is incredibly powerful. But anything that powerful can also be used for the wrong things. And so this is where, frankly, governments need to step up. They really need to get a grip on this.
Yeah.
And make sure that they stay ahead of it, because otherwise I do think we're in for worrying times. But at least people are talking about it. There are a lot of really smart people out there thinking about how do we contain it, or how do we utilize it appropriately, and how do we safeguard people's livelihoods and futures.
In the end, it's just a tool, and it's the mind and the hands that are using it that are the solution or the problem. Either way. Yeah,
exactly.
Well, thank you, Jo. It was an interesting conversation. I encourage people to find out more about GARP. They can at garp.org. And thanks for tuning in, everyone. This podcast is just one way ED4S supports sustainability and sustainability upskilling. Follow us on LinkedIn or connect directly to stay updated on future learning opportunities. Take care, everybody. Bye-bye.
If today's episode sparked ideas for your team, visit ed4s.org. That's ed4s.org to explore our customizable corporate learning solutions or book a quick discovery call. You don't have to figure it out alone.